Hello guys, my name is Gustav X and we're back to our lessons. So this is episode 3. We are going to learn about liquidity. So you guys probably have this book. I left it in the description of the other video, but if you don't have the book, I will leave it in the description of this video. So first of all, we are going to learn about liquidity. What types of liquidity there exists, how to adapt the liquidity to our concepts. So let me go to the liquidity page right now. So here is our liquidity page. So guys, liquidity in the forex market, basically it's where the positions of the traders are, where the stop losses are. So basically, if you make a position, like for example, I make a buy, I will put my stop loss somewhere. So that is liquidity, where we put our stop losses in. So basically, in the forex market is a zero sum game, which means that for a trader or institutional trader to buy or sell one currency pair, is necessary that there is other trader with an opposite position. If smart money or else banks want to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called liquidity. So liquidity is defined by stop losses, what I was explaining back there. Where the stop losses exist is where the liquidity exists also. Smart money needs to activate the stop losses of existing orders in the market so that they can place their position in the market. The banks manipulate price because of liquidity. But why? Banks negotiate large trading volumes and sometimes find it difficult to find the other side of their trades. So they manipulate price so that they can have their positions in the markets. Liquidity types. In the forex market, there are two types of liquidity: buy stops liquidity, buy side liquidity, sell stops liquidity, sell side liquidity. Buy stops liquidity. The buy stops liquidity is originated by stop losses of sell orders. After the buy stops liquidity is taken, the market reverses to the downside because the banks use buy stops liquidity to place sell orders in the markets. What to focus on buy stops liquidities? First of all, previous month high, previous week high, previous day high, high of the day, old highs, swing highs, equal highs, retail resistance. So basically all that retail concepts are liquidity, but I will explain it for you guys how you will adapt these concepts in the market. So this is an example of buy side liquidity getting taken. So price created a high, right? And then buy side liquidity gets taken and price reversed. Price created the equal highs and then buy side liquidity gets taken and price reversed. So basically is this. Price created this high, buy side liquidity was taken and then price reversed. Price created this high, buy side liquidity was taken and then price reversed. Previous month high liquidity. This is PMH, previous month high liquidity. Previous week high liquidity. Look, first of all, previous week high buy side liquidity got taken and then price melted down. And then in this case here as well, buy side liquidity got taken. Here, buy side liquidity from the previous week high was taken and then price went down. In the same case, here buy side liquidity got taken of the previous week high and the price is going down. Basically, it's this simple pattern here. So guys, this repeats itself in basically every time. So let's look at here at the previous daily high. Most of people call this candle range theory, just for you to know, but basically these are concepts that exist since the beginning of the ICT concepts. So previous daily high, buy side liquidity taken, and then price dropped. The same thing here, buy side liquidity got taken and then price dropped. The same thing here, buy side liquidity got taken over this high and then price dropped. So all the high of the day here, buy side liquidity got taken and then price dropped off the high of the day. So let's look for these cases, all of these cases in the chart because I like things visually seen, right? Okay, let's go to our charts. We are now in USD CAD. Let's go to the monthly time frame. So first of all, we are here. So if we look closer, see this high here, this last high right here. No, I will not use this high. I will use this high right here. Sorry. See this high right here. This is the high of December. This high right here. So I will mark this as red just for us to see well. Can you see it? I believe you can see it. I'll make it a little bit thicker for us to see well, right? So here, basically, the liquidity within the market was taken right here. And the moment the liquidity was taken, price simply dropped, right? Price simply dropped. Price simply dropped. This is one example. Let's look at this low right here. Can we take a closer look to this low right here? Price took the liquidity and went a little bit up here. Price respected the liquidity as well, took the liquidity and went up right here. What can we see in this candle right here? This is the monthly time frame, right? Price took the liquidity and went a lot up. All the pullbacks were made after liquidity was taken. So it's here. The thing works. The thing works. So let's see this monthly candle here. Price closed above, right? And then basically price took this liquidity right here and then price dropped, right? This liquidity here, sorry guys, this liquidity here, this liquidity here. So I believe you guys can see and understand these concepts as well as I'm seeing right now. So this is basically how it applies in the monthly time frame. If you're a position trader, I will teach you guys how to place positions as a position trader, but basically, yeah, it won't be right now. See this high right here, price took it and then price reversed over this liquidity right here. This liquidity in this high wasn't not taken. This created basically a double top, right? And yeah, this works all the way to other sides. For example, this liquidity here got taken and then price reverse. This liquidity here, especially this liquidity here, got taken and then price reversed. See, where can I put again some liquidity concepts? Oh, this liquidity down here of this candle, price didn't close above, price didn't close below, sorry. So liquidity was taken and then price reversed to the buy side. So right now, price closed above this candle. Price closed above. If price had closed below, this would be very good to us, but price basically we're coming to take these double tops right here. See these double tops right here? These are another form of liquidity. Let me show you. Equal highs, right? Equal highs. What happened? Buy side liquidity taken, right? Sorry. Equal highs. Let me show you guys. Equal highs right here. What happened? Buy side liquidity. Equal highs. Buy side liquidity taken, and then price drop. This is the fucking monthly time frame, bro. If you place a trade using this concept, simply you will know what the trade is going to do. You know. So let's go to the weekly time frame just for us to try to spot these liquidity moves. So we can see some liquidity moves around, first of all, this high right here. See this low right here, this previous week low right here, and basically, yeah, this previous week low right here. We're just here to spot liquidity. This lesson will be all about liquidity. Only liquidity concept. We'll talk about liquidity concepts from the beginning to the end. This is why I didn't want to teach the liquidity concepts in the lessons below, because look at this liquidity, how price reacted. Price came, simply took this liquidity. With this, only just this information, I can make some buy positions out of this. I can expect price to go up on USD CAD because price took liquidity and rejected after a big pullback. But yeah, let's see on other time frames. For example, 1 hour time frame here, this liquidity right here. Price simply took the liquidity and fell right here. These two candles, like previous day highs, for example, this day high right here, I don't know if you can see it, but I know you guys spotted with me. These two highs right here, this high was made and then price took the liquidity of this high and then fell. The same thing happened right here. This high was made, price took the liquidity of the high and then price fell. The same thing happening right here. Let me mark this down here. The daily high made liquidity here, basically took the liquidity of 1 week, and basically the last day liquidity of that candle. Then price fell, and this price created these highs. So if we look closer, here, price took the liquidity of the day below, right? The day before. Like from the 8 to the 9, price came to the liquidity and then fell. So, liquidity concepts do work. For example, here at the reversal case, price basically took the liquidity and then went up, right? So, people can call this candle range theory, guys. People can call it CRT. Let me Google it for you to show it to you guys what people call. So, if you look closer, look at this. You see this Yeah, let me try to see a better image of it with a little bit of quality for to me to show it to you guys. Yeah, this image is really good. Let me save it. Oh, this was posted by TradingView, not officially because TradingView doesn't promote strategies or stuff like that. But so if we can see it here, price came, took the liquidity of the high. Sorry. In this case, price first took the liquidity of the low here and then came up like all the way up. Here in this case, price took the liquidity of the high and this high took the liquidity and then price fell. In this case, price took the liquidity of this low and then price went up. So it's the same thing that's happening here. The candle range theory, it's based out of liquidity. It's just a way of calling out this type of liquidity moves, but we need to know the basis of it. So we already covered all of these, all highs, high of the day, all of these four things right here we covered. And now also equal highs we covered. Now we need to tell you how to adapt liquidity into our strategy. So guys, you know the basis, right? Let me see if there isn't something I missed here to tell you guys. In the sell side is the same thing, just the same thing, and you don't need to beat yourself up about this. Yeah, you will see a lot of things like manipulations and all these things, but I will talk about this later. How to adapt liquidity in our strategy. So guys, first of all, we need to know where is liquidity. First spot there has liquidity. Sorry, let me go a little bit up. It's the lows. So the lows of a move, money have liquidity. Also, the double bottoms or the double tops, right? Because this is basically reverse, right? So here liquidity lies, right? Sorry, and then we have the trend line liquidity. For example, price is within a trend. So the base, the support of the trend is basically our liquidity. So these are the types of liquidity that we are going to learn within our strategy. You already learned where liquidity lies, everything and stuff like that. But now you need to learn how to use liquidity in your daily basis, in your daily time frame, like in your intraday, in your scalping, in basically use liquidity in every trade you do, because you will not only wait for the highs and the lows being taken to make such moves. You need to adapt and know where to spot liquidity. So first model I will present to you guys is basically when price is within a uptrend, right? Broke structure, and then price did something like this and broke structure again, right? We broke structure here, we broke structure here, right? And we left a liquidity down here. money, we left liquidity down here, and basically within this low right here we have imbalance. Sorry guys, we have imbalance and a demand. So if you spot something like this within the market, right, note something. Price will definitely come down here, take this liquidity, come to this demand, and then go back to breaking this high. Why price does that? Because we learned like year before, this is the first model. Give a screenshot out of this, draw it in somewhere, I will show it to you guys. So in this point of liquidity, we will try to find this within our models that I told you guys last lesson, like those imbalance, inefficiency models with demand, with order blocks, all that. We will apply the liquidity concept. So the first appliness is this with the double bottom, right? I think this is the most easy way to apply it. Why, Yuri? Why we should trust this model? Because here people will think this is an order block, and then people will do a trade out of this, like trade here, stop loss down here, take profit down here. So if price does this, people will trade this and they will be stopped down, right? Because why? There are liquidity within the lows. Every low, every high has liquidity. Understand that. Liquidity is in the lows, it's in the highs. Understand that. So guys, this is the first model. This will not be an order block. This will simply be an inducement. You will get this with practice and stuff like that, but this will be an inducement, right? To make price come here and then go up. So the second model is very basic, like price goes and creates simply a low, break structure, and then comes again and then goes up. So where the liquidity will lie down here, right? Money. The liquidity will lie down here, and within this liquidity, we will see like a breakout structure here, a buy side liquidity being taken here, right? An imbalance here around this zone right here below the liquidity, and obviously our entry block, our demand or order block or something like that. So this is one other trade idea, not a trade idea, a trade model. Understand this trade model. See this one first, this one second, and then we are going to our trend line liquidity model. This applied to the buy side and the sell side. So practically price moved up, moved down, and then created a very good trend line. Like price is going really up and creating a great trend line. So basically stop losses will be here because people are buying in this trend line. Like one is buying here, one is buying here, one is buying here, one is buying here. So a lot of people are buying in this trend line. So guys, basically if there is an imbalance here, an inefficiency, price will always come to the inefficiency, guys. Always. It doesn't matter. Price needs to fill in the inefficiency. So here basically we will have our demand, and then price will come, take this low, and then go up. Oh, another type of liquidity that I need to explain to you guys is basically the accumulation. So, within the accumulation, there are a lot of things that happen, and basically, yeah, it's hard to say what's going to happen next. It depends really about where the market is lying. So, accumulations are also a base of liquidity, and we use them as the same way of the lows or the highs. Let me show it to you guys. And you notice something? I have all these models inside my head. Like you must have them too. So first model, take a screenshot. Second model, take a screenshot. Third model, take a screenshot. Now the accumulation by model. So let's go. Price is coming from a buy range. So price starting to accumulates a lot, and then price breaks to the upside. If there is an imbalance right here, and or the block or demand zone right here, and basically price here broke structure, but remember this is liquidity. Buyers are happy, sellers are unhappy. So what price will do within this case of accumulation? Price will do what we call accumulation, manipulation, and distribution, right? But we'll study this in the next lesson, I hope. And then price will come back here and then continue up to take the high created. So this is a great model to trade with if you are a beginner or something like that. Just read this book, bro. I think you will learn a lot of out of it, but basically these are my own concepts and my strategy itself. So that book isn't my strategy, it's just something that I'm using to teach you guys and for you guys to have it. But basically, first model, second model, third model, multi input and headpins all the time, and last but not least, the fourth model. What about the reversal model? The reversal model, guys, understand something. The reversal model is price came to a level. Sorry. Is basically price created a breakout structure, right? Created another breakout structure, and then price reversed, created a little bit of inefficiency to make people try to sell here, and then came up again just to sell off. So let's draw this again, like price here broke structure, right? Broke structure broke structure, and then price made a change of character, created liquidity here because this is a lows generate liquidity. So within this liquidity created an imbalance or fair value gap or inefficiency right here, and then price created an demand or order block entry zone. So you enter, you sell right here, and then price will drop. So this is the reversal pattern basically. So I will show to you guys right now every single one of these models in the charts live. So let's go to which pair we are choosing today, GBP USD. First of all, guys, I made a crazy trade on JBP USD today. I didn't share it to a lot of people because, bro, I was simply not willing to do this. Let me redraw this all again. using the things that I'm teaching to you guys. First but not least, let's go to the 15-minute chart. So in the 15-minute chart, we can identify that there is an demand here with fair value gap. Look at this demand, how powerful it is. It has imbalance. It has liquidity, that is this low right here, right? So this will totally be respected at some point, but trend will call it the most, right? So we have this imbalance first, but don't forget that we are in an uptrend. We are bullish. So if you are bullish, we need to buy, not sell. So we need to see buy positions in order with this knowledge that we have. So forget this movement down here. This is not worthy for us in the moment, right? In the moment, I was saying like because this is a reversal pattern, and I will explain it to you guys how it worked, how it worked, right worked, because this is a perfect reversal pattern, right? So guys, understand something. We are bullish. So if you are bullish, where are the spots that we had like most likely imbalances? So we had imbalance here. Despite this was a little bit mitigated, but it's still valid. We had an imbalance right here. So we will call this first zone right here a tricky zone, because here we must wait for confirmation, right? I told you guys this last lesson. The second zone, we will call it extreme. We don't need confirmation. If price gets to the extreme zone, I'm buying. Extreme. So what happened? Let me go to the 5 minute time frame. So basically, the extreme zoom is a little bit covered, but yeah, basically we have the imbalance, we have everything. The imbalance is still here, this candle, and basically price broke structure here, break of structure, price broke structure here, break of structure, and price left this high right here after breaking structure. So this was the structure that must been broken. So this was the target range. Look at the low. Price didn't break this low. So this low became, this was not a change of character. This was just liquidity. So let's mark down liquidity. And then what price did? Price first came and took the highs, creating a break of structure, right? But don't forget we had liquidity down here that must be taken. So our order basically will be here just to the buy side right here. Basically our order would be a little bit like this, because we will have, our stop losses a little bit like this. So guys, see this model here. This is a practical situation that happened today with this model right here. Let me show it to you guys. With this model right here. See this? See this model right here? Isn't it the same of this model right here? It's the same model. Liquidity in the upside, liquidity in the downside. Price first took the upside liquidity. Why? Because to make the sellers happy and make the sellers, the buyers, the sellers sad and the buyers happy. And then Price respected. Look at where it's respected our demand with inefficiency and liquidity. So at this time, people were selling off, but I knew I didn't want to catch this sell off. Why? Because we are in an uptrend. I must look for buys. So price sell off took this liquidity and came here to our zone in the 15-minute time frame. So how this looks to you? First touch in the demand, second touch in the demand is a confirmation, and voila, price simply went to take profit. This happened today around 12:13 in UTC minus 3. And then let me show you guys a reversal pattern here. First of all, guys, we were bearish, right? We made this pullback and then we broke it again. So this zone right here, this is a breakout structure. So the high that must be taken for price to reverse is this high. So what happened? This movement right here took this high. So this was a chalk change of character. So within this change of character, we have two zones. We have our extreme zone and we have our tricky zone. Can you find it? Yes, this is our imbalance, right? This is our tricky zone. Did we see confirmation on our tricky zone? No. If we didn't see confirmation in our tricky zone, price must have tapped this zone two times to confirm entry. This means this tricky zone becomes liquidity right here. So within this liquidity, we must enter on our extreme zone or order block, or dash order block, right? Because this is most likely an order block. And notice something, we have liquidity right down here. We have also imbalance, right? And then what price did? Price simply came, sorry guys, this is a sell position, and reversed. And where did it stop? It didn't stop till this highs. So basically our trade will be a little bit like this, around to this high and basically to this demand. So basically this will be an 11-hour trade win in the 15-minute time frame. Let's try to see it in the 5-minute time frame. How was it looking? So in the 5-minute time frame was looking good as well. Look at this. We have our imbalance right here. We have our tricky zone. We have our imbalance. We have our liquidity. We have here. We have this block right here, and basically past touched it and went up. So if we mark the order block, we also get a way better risk to reward ratio. So look at this. Tap the order block, stop loss below the order block, and then price surf the movement to the highs. And look at the crazy risk to reward ratio if we refined it. Just 17-hour trade. So guys, this is a beautiful way to use this knowledge about liquidity, right? It happens in every pair. So this is basically a reversal pattern. And within this reversal pattern, notice something. Notice something very beautiful right now. So see this high right here. This high basically is a chalk within a chalk, like a change of structure within a change of structure. So we have within this change of structure, we have liquidity here. We have our imbalance right here, and basically we have our demand. So price went up in the first demand, went up in the second extreme order block, went up in the third, basically third tricky zone in the 15-minute time frame, and price is still surfing the movement to the buy side, guys. So does it work? Yes, it works. Just needs you to practice this strategy and know how to notice these setups. So now I will explain something a little bit different from what we were learning. Let's go back to our spreadsheet in our USD CAD. So guys, you notice something. We noticed that within the liquidity, we had some liquidity that was built up after the movement, some that was built up in the movement. So we need to make a difference in that. So I don't know if you guys ever heard about it, but there's something called internal range liquidity and external range liquidity. Let me write this down right here. IRL dash external range liquidity. So if I Google this, let me try Google it first and just show it to you guys. I use it in my concept, but I love to Google things for you guys to Google as well. So we have here internal range liquidity and external range liquidity. So guys, let me see if someone explained this well. Within all these concepts, nobody can explain this away my students will understand. Sorry guys, nobody is able to explain this the way I want to explain to you guys. I wanted to see here just in case if you guys don't understanding, and but basic I will spend the next 5 minutes explaining this. So internal range liquidity and external range liquidity. So when do we call it internal range liquidity? Within a bullish trend, right? Price retraces a little bit, right? These small retracements, it's the continuations. It's not the, let me explain it to you guys. These small retracements right here, it's part of the expansion movement. Price is still expanding, right? This is not a pullback. This is a continuation expanding move. So within this down candles, price creates liquidity. And this liquidity basically we call it internal range liquidity. Because why we call it internal range liquidity? Because it was formed during the expansion move. When price expands and creates a little bit of lows of down candles and stuff like that, it's called internal range liquidity. And then this is basically, but if price, this is basically an internal range liquidity, yes. So this is expansion, this is retracement. So the internal range liquidity is the liquidity that is created in the expansion move. Understand it? Understand it? Okay, good. Let me show you the unit chart. So USD, 5 minute time frame. Okay, let's spot internal range liquidity. So delete all this dumping. So price here retraced. Look at this retracement. Sorry guys, retracement, right? Expansion move, right? Let's pay attention to the expansion move. Sorry. Let's pay attention to the expansion move. During this expansion move, price went up, created a little bit of down candles. This is IRL. This acts is internal range liquidity. And notice something, price came and respected the demand with order block. So basically, price created internal range liquidity imbalance, and then price took the internal range liquidity, swept the imbalance, and then went a little bit up, and then respected this order block and continued down because basically we were in a downtrend, right? Again, this is what, look at this. Price was expanding down but created this candle right here. This is what? Internal range liquidity. Within this internal range liquidity, we have our imbalance. And in that imbalance, we have our demand candle, you know. And look at what happened. Price came, swept a little bit up. What is this? This little sweep up. It's because in the 15-minute, basically, our demand extends to this level. So if your zone is taken in the 5 minute, just look at the 15-minute to see how where the demand really starts. So this demand really starts all the way over here, and the liquidity on this demand is this, the internal range liquidity. So let me show you to you guys what external range liquidity means. So guys, let me go a little bit up. So let's pretend price simply created an expansion move without leaving internal range liquidity. So price comes back, creates a little bit down move, and then moves up. This down move becomes external range liquidity because it was created in the retracement. Internal range liquidity, expansion move. External range liquidity, retracement moves. So price created this, and this basically price will come here and then go up. So let me show it to you where is the liquidity. So this is external range liquidity. Why? Because it was created in the retracement, not in the expansion move. So within this external range liquidity, we have our imbalance, right? And then we have our demand candle. And then price comes, steps, and goes to take profit. So let's go and see this in the chart. Same example. Let's go and look for something. Let's notice something. Price here, I agree, price created internal range liquidity. Yes. But price came in the retracement move and moved back a little bit. So this move down becomes external range liquidity, especially because this is a double top. And you guys know very well that if it's a double top, basically our setup is 100% valid. So imbalance right there, and then our demand candle. And look at what happened at the ERL, like the external range liquidity that was created in the retracement. The external range liquidity was taken perfectly, and then price dropped like 1,000 points. And then price just keep dropping and keep dropping until now. Like basically it's keeping dropping until now. Obviously, let's check for another example of this type of liquidity. So let me see. This is internal liquidity. Oh no, this is our external range liquidity because this was a pullback. So understand something. Price was moving up from year to year, creating this breakout structure right here, right? Breakout structure. Within this breakout structure, price created this imbalance right here. This imbalance. Let's try imbalance. So in this imbalance, basically, Price in the retracement move, because this is a retracement move. This is not part of the big move. This is a retracement move. If you don't believe me, just go in the 1 minute chart and look how many candles are here. And this is a retracement move right here. And in this retracement, price created external range liquidity. So this is a valid type of liquidity for our entries, external range liquidity. So in this external range liquidity, basically price left at this demand block right here, and look at simply what happened. Price came, basically took the external range liquidity, but if we check here, let me move this a little bit below. In this demand, we also have an order block. So we can perfectly extend this to here and see where it will react. So as we see, price came, reacted to the order block, right? And price went up. Price went up a lot of points, a lot of points, a lot of points. 16-hour trade, boom, chakalaka. So in the 15-minute time frame, let's see if we can see this thing clear. Basically in the 15-minute time frame, you can't enter in this demand right here because it's basically a down candle, but it's there in the 1 minute. In the 3 minute time frame, we can see it clearly that we have here within this breakout structure this order block, and then we have our in this expansion move, and then the expansion move ended, created the pullback that was in, and then this pullback must break structure again. This external range liquidity broke structure, and then price came up, took it, and then went up. So guys, this is a simple explanation of internal range liquidity, external range liquidity, and other liquidity concepts. So what can I explain you now? Now I must explain you the liquidity sweep. This is was ERL and ERL. Now we will explain the turtle soup, my friends. The turtle soup. Our turtle soup that was invented by Linda Rachne, something like that. I will leave her book in the link below. I'm not sure I have the book in my computer, but I have the physical book and I have it on my phone as is an ebook. So it's very interesting for a trader to go there and look at that book, because damn, bro, damn, she cooked this strategy. So Larry Williams built this strategy from scratch with Linda and other traders back in 1989, 1990s, and stuff like that. So basically, price creates a high, a trades high, creates a high, and then trades low, right? So in this trading low, basically price comes back and takes the high and doesn't close above. It doesn't create a breakout structure. It creates basically a liquidity sweep. And this liquidity sweep that price creates, it's our turtle soup to enter a trade and melt down with the price. So I will not mark all this structure like bars and chalk. I will mark the liquidity points. So price broke structure here, and then price started moving down within here, and then price broke structure again here, right? Broke structure, created some kind of SMS right here, shifting market structure, right? And then price created a choke right here and starting showing bullish position again. And when it goes to the last high, basically price creates a turtle soup. And this turtle soup, the liquidity sweep, price takes the high and then starts coming down. Let me show it to you in the chart how a liquidity sweep looks like. I don't know if you will be able to. No, I think here it's not a good time to see liquidity sweeps. Liquidity sweeps is easily seen on the 15-minute time frame. Yeah, unfortunately, I cannot spot the liquidity sweeps. I don't know why. Let me check the 1 hour time frame. Like, this is a very bullish market. Yeah, it's right. 1 hour on EU. Can I see a liquidity sweep example? In the 1 hour, we have this liquidity sweep here. We have this liquidity sweep here. So let me go to the 15-minute right here. So understand something. Yeah, let me start from the beginning. So we are in the 1 hour. This was basically the first thing I started to explain in this lesson. So if you paid attention to the first things I started to talk about, it's basically this thing but called the liquidity sweep. So we say this liquidity sweep price didn't close above, price simply swept the high. And when we go to the lower time frame, right, 15 minutes, we can clearly see the price simply sweep this high right here. So this means the bullish power is ending, right? So I will call this turtle. And then when this liquidity sweep happened, price melted down and created a change of structure here. Within this change of structure, like chalk, right? Let's go back to the 5 minute time frame. So price created the turtle soup here, right? And then price created a chalk, a reversal. Another thing, guys, understand something. Liquidity slips most happens on the 1 minute time frame and the second time frame. It's hard to spot it in the higher time frame, but yeah, in the 1 minute it happens very often, like very often, like very often. I'll make a lesson just showing to you guys what is about it. So within this change of structure, right, we can see this candle that left our internal range liquidity, right? And in this internal range liquidity, price simply came, didn't respect any block, simply come and respected the inefficiency. Should you guys enter in this thing? No, you should not enter in this thing. You must look for the tripping formations, moves with imbalance. So this zone was already respected. So there is no more liquidity up there. If we extend our Fibonacci, we will see that 618.78 price is dropping, right? Price is respecting. So within this drop move, we found our imbalance right here. Let me show it from another way, like for you guys to see. We find our imbalance right here. We already know price is moving down because of this thing right here, this liquidity sweep right here. Because price did here was a liquidity sweep of internal range liquidity. Look at this. In the fair value gap, this is a fair value gap in efficiency, and then price made a liquidity sweep here, internal range liquidity sweep, and then price melted, and we found our imbalance right here. And basically our trade will be this one right here. Ah, this is a big stop loss, bro. This is just an entry model. You can refine it if you want. So basically price fell a lot. And notice something very interesting. See this high right here. Basically price came again to the same zone but in the 50% zone. So if you saw this again, this same setup, you could have taken it because basically it's showing bearish momentum, right? So now you have an entry with a bigger risk to reward ratio, right? That's what you guys want, like 1 to 100 risk to reward ratio. I think that's impossible to catch, but for me, I will cross this thing in about 5 hours, right? And basically was this, guys. And why did price came here? And we should know this was a sell side because price took this liquidity right here, this high right here. This is internal, no, this is external range liquidity, right? Because it was created on the pullback, so basically generated liquidity and price fell. So, guys, in the 1 minute time frame, I don't know if price will allow me to go just so back in the market, but oh, now let me cook. Look at this. Look at this. This is perfect turtle soup. Let me delete this. So price took the liquidity. Price is on a higher time frame demand. So price came, broke structure here in the 1 minute time frame. Remember when I said to you guys that turtle soups often happens in the 1 minute time frame. Now look and watch absolute cinema. Price made a change of structure here, chalk, and basically within this chalk, price created this imbalance right here. So price came, filled this imbalance right here within this candle. You could perfectly enter here, stop loss above. Obviously you would be very in panic right now, but when you extend your take profit, you will get a very crazy risk to reward ratio trade, like 50%, bro. This in the 1 minute time frame. This is why I think one of the last lessons I will give it to you guys is how to trade the 1 minute time frame, how to spot the things, and how to see things working. And then you guys will sit down, practice, and see if the strategy worked for you guys. So, guys, peace. Let's work.